So, hi everyone. I'm here with Paul Rout today, who's the SVP of Consultancy Sales at Whenfresh. Paul, welcome and thank you very much for joining me today.
Thanks, Chris.
So you guys work in the data industry, and you've got a lot of property data, and specifically, I suppose, around things like collections and in that kind of area, consultancy and that kind of areas. Good to get your reflections, I suppose, initially, just around what have you seen over the last year, and sort of a few thoughts really around where do you think we go, where do we sit today, and where do we go from here?
Well, I guess for me, I've seen an increase in, the need for automation. I think people are looking at different data sources. I think that's the key thing. I'm from a CRA background, and we've sort of done, I'd always say we've done data to death in the collection space. So where we've been quite successful is obviously with the property data that you've sort of mentioned in there, and really sort of combining that with the CRA piece. But I think traditionally the problem with property data, it's very, very difficult to sort of manage on that automation plane. That's changed over the last couple of years now, that access to standard property data around attributes, transactions, and especially the land registry, it's a lot easier to get that sort of data in. We work across sort of the contact element of collections, the affordability element of collections. I think where it's really hitting home at the moment, and obviously because there's an increase in debt that's coming, a wave, I would imagine, we're looking at recoveries and litigation really heavily at the moment.
So there's been a big move to, I suppose, digital and sort of like remote access for getting information, because you can't do things like house visits, site visits, field visits, those kind of things. Are they doing it for like pre-valuations, post-valuations? I mean, what are some of the use cases?
So yeah, we pre-purchase on collections especially, we're doing a lot of work on at the moment. So our data is pretty much in three sort of areas. There's the transactional element, which is people sort of moving, whether it's a sale or a rent, obviously sale prices, etc. On the back of that, we have an attributional element to it as well, which is property type. The thing that's really sort of surprised me coming out of that is people don't understand property types, whether it's a business or a residential premises. We've seen this a lot when we've been doing central government work, in terms of people putting businesses through in terms of an application for, let's say, a benefit. And there's nobody can actually distinguish whether it's a residential or a business property, which obviously working on fraud around that area. So it's quite a key sort of piece. And I guess the last piece is around the sort of valuation and the legal entity, the property itself. And again, that goes from two stages. Traditionally, that's at the end of the process where people are trying to sort of put charging orders on properties, for example. We've brought that up front, so the book can be assessed whether there's an opportunity to do that. So that's the sort of real change that sort of happened.
I mean, you guys are sort of like specialized in property data, which is different from from consumer data. I mean, how do you sort of like, how is it useful? I mean, because obviously loans, particularly loans in the loan market, are made from a personal point of view. I mean, so like the individuals borrow money rather than properties, but obviously the property data can be useful. I mean, how do you match those across? How can it be used?
I guess, it's all rooted in the fact that you're not going to get a loan without being in a property. So again, the assessment of that, especially on the securitized loans and that kind of thing, we're looking at the value of the properties and things like that. We also have things like people assessing properties on incompatible lifestyle type pieces as well, where there's an affordability element. You see the credit data which comes in about how you perform, but also it's interesting for businesses to know, how valuable is your house? What do we think the mortgage is on it without going to the credit data? How long have you had it? It's that kind of thing that sort of people are interested in, and it's quite simple to connect those things through. I mean, we use pretty much the standard thing that everybody else uses, UPRN with PATH, so you can link that across. We deal with pretty much all of the bureaus, so we can key everything up on that and deliver it through their sort of decisioning engines. It's pretty easy to do. I think the only complication that we've sort of had, but we've resolved, is the land registry. They do a lot of things with addresses. They're not overly clean, to be fair. They have a title number on there, but we've now also resolved all that through to a geography level through OS, which really passes through to PATH and the Royal Mail.
Yeah, so I suppose it's really sort of linking property data against the consumer data, and then they're sort of augmenting almost like the customer records with additional data, right? So,
absolutely. I mean, the key case on that is in effect, we provide valuations to the Bank of England, for example. So we have a series of valuations. We have what we call the EPM, which is the flood sale value. It's the lowest price that property is ever going to go for in 90 days, which maps across to the collection cycle anyway. But the marriage between the bureau data having a mortgage balance, for example, and us having the valuation enables us to do a really accurate equity piece. I think the thing that's changed, that was really the basic level in terms of calculating equity. What we're bringing in now as well is, I guess, looking at the land registry and the full title and being able to automate that into a data flow. We can make the assessment of whether it's actually worth doing that charge and looking at any, covenants, restrictions, as well as the charge details on that. So you know whether to execute that charge in order or not.
What about trending in valuations? So I know you've got things like you've got in access to information like council tax, expenses, affordability type stuff, as well as like things like changes in valuation, or even in changes in things like flood risk. And that can be quite interesting in terms of like, are property valuations changing, or are expenses changing, and what impact does that then have on the consumer?
No, absolutely, yeah. I mean, and it's a real-time thing. We've got access to about 21 million billing points in terms of utility bills and some of the things that you've mentioned. Obviously, house prices are going up at the moment quite significantly. In some areas, they're not, and we can sort of track all that thing. We did a piece of work for a water company many years ago, which was looking at it was effectively collectability, and we used trending data in rentals to see where the sort of key pockets were, and it predicted sort of defaults really, really well compared to some of the traditional measures that you'd use from bureau data, for example. So it all sort of makes a difference. I think I probably can't stress enough though. I mean, our stuff standalone works really well. The power comes when you do connect all that data up to wider data sources as well. Yeah. There's always been a little bit missing, I think, for me, having worked in that data arena. I always put it as a sort of a 360-degree view of a consumer, I guess. We've been very heavy on credit and credit behaviour, but the thing that's been missing has always been assets. And I think it's not just the asset itself and the value of that asset. I think it's the behaviour around that asset as well. So when people are moving, changing, moving up, moving down in terms of the properties, it tells you a lot about that individual. And again, everybody's rooted in a property. You can't get any access to pretty much any service or any financial services, especially without a property.
Yeah, so I know you do move alerts, right, as well. So I know you got access to properties. So if there's been a move, which is it's quite interesting, things like change of tenancy, those kind of things. And it's almost like, well, how does that then link through to potentially almost like downstream risk that's happening? So you almost like using that to almost like get early notification.
Absolutely, early warning.
Potential for
Yeah, so I guess, I mean, the key application we're doing that for the industry at the moment is utilities. So we're pushing the mover alert system into utilities as an early warning piece up front for billing. So that's the first bit. It's all around the movers process. There's a lot of work across all of the utilities at the moment around that. But obviously that has on a knock-on effect if you look at the consumer life cycle as well, because if they've got anybody in a pool where there's some arrears or whatever, being notified early that there's a potential that they'll either move due to a sale or to a rental, really, really important. And I think because the data that we have transactionally on a property, it doesn't rely on the consumer informing anybody. So they don't have to inform a change of address. We see that property's changed because of a legal process, conveyancing, for example, or a landlord's advertising a property through one of the portals or one of the other sources of data that we have. So it's not executed. It can't be hidden by the individual. The property tells you a lot about the behaviour of the individual and what's actually going on in their lives.
And how much of that is, I suppose, is risk and potential risk? I mean, in collections, we talk about risk of default versus potentially, I suppose, risk of poor customer outcomes as well. Because you get the earlier you get hold of people, the better the customer, the more chance you have of offsetting sort of or avoiding any kind of poor outcome as well. I mean, is that part of it too?
No, absolutely. I mean, we use it across the piece. I mean, the main driver for the movers process within utilities, for example, is customer service, and also there's a little bit of retention on that as well. Because if you're moving within their operating area as well, they want to try and retain the business in many cases, so we sort of use it for that. But as I said, it has a sort of a multitude. It's multifaceted in terms of the areas that you can sort of use it in. It's just a no-brainer, really. It's a change that's sort of made, and it's a change that impacts the business that you do with the individual. So,
what about property data? Just sort of thinking out loud, can any of that stuff be used for things like vulnerability or identifying particularly vulnerable areas or vulnerable kind of situations? Or or do you think it's purely that's much more transactional, maybe?
Yes, so obviously, I mean, the standard answer to that would be we know where low rental areas are. We know the sort of demographic makeup of those areas as well. To a certain extent, we do hold some of the demographics from some of the suppliers. But I think the other thing that we offer we've got access to all the house and multiple occupancy register in the UK. So we know for pretty much 98% of all the local authorities in the UK which properties are HMOs. So that sort of gives you that kind of information that you sort of need. The thing that we do for local authorities on HMOs is we identify unlicensed HMOs. So we know that properties exhibit a certain characteristic which make them sort of HMOs. They have 3 licensing schemes. They have a selective, additional, and mandatory one in the UK. So we're doing a lot of work at the moment. But again, that has a knock-on in terms of looking at vulnerability and that whole sort of social aspect of it as well.
So it becomes like another risk indicator, almost like you got your dials. Like, this is maybe something that needs to be investigated, sort of thing.
And I think if you roll that round to the whole collections piece as well, there's a bit on there about transiency as well. We see high turnover rentals. We see HMOs don't tend to have the individual and their rooms are rented all the time. They tend to turn over within 6 months. So it's those kind of measures you would see potentially from the bureau, but we know that there's sort of thin file on the bureau where you don't get certain people. But I think again, it's the early warning of that, and it doesn't take that individual to inform about that move. The property tells us everything we need to know.
Yeah, it's sort of getting on the front foot based on where it is. We've got so much data now, I suppose, with digital. I mean, we're awash with data, and everything's being sort of like centralized with especially with like the cloud, and it's all available sort of like through APIs. How do we decide where to look? I mean, it's becoming almost like a problem, like where to look. Whereas before it was, we got this piece of data and it's very logical around what it kind of means. So, people falling in arrears, just very, very simple. I mean, we know that's well, maybe someone's got more making payments, but now we've got these multiple pieces of data. They all tell us slightly different things, and the combination of them all tells us something. But how do we get to the combination? And what's your advice on how do we get to I suppose almost like interpreting it? How do we get to understanding it?
I guess, I mean, we've sort of worked quite heavily, as I mentioned, through the CRAs, and they do use some of the property data quite a bit. It's sort of getting in there. In terms of, I guess, it's educating the market that this data is available. I think that's been one of the big problems. Is there's 2 reasons for that. One, they physically don't know that it's there, and it's understanding how you combine that and how you use it. Or secondly, it's been very complicated to get at it. I mean, I talked about the land registry before. Very, very difficult system to use. You can do ownership checks, but if you want the title deed, you've got to pull down the PDF. You've got to go through that manually. I think that they're the changes. It's making those things digitized a lot more, so you can use it, within a decision engine. You can distribute it in the right way, and then you can actually use it as a part of an analytics suite to be able to do that analysis and look at the interactions with the data. I think that's the step that's sort of been made now. It's making it more standardized with the data sets that are out there, and it allows you to interpret it in a better way.
Yeah. So it's almost like it's the data cleansing. So you've done the data cleansing. So now it could be sort of machine readable. It can be then interpreted to be able to then make those linkages.
I think a good example of that, Chris, is we've been doing some work for a debt purchaser at the moment, and they focus on commercial debt more rather than consumer. But one of the things that they were interested in, they couldn't get hold of, they've got sizable portfolios coming in, but there's covenants and restricted covenants on the property which don't appear typically within the charge element of that piece. So what we've been able to do is we've been able to extract all that textual field and bring out the key things like who the proprietor is, who the charge is with, whether it's a county court judgment, which sometimes doesn't even appear in the charging sort of piece. And we've managed to put that into a data set. And what they're able to do now is, rather than having to scan all of these title deeds, it's all there. They can put the rules engine on top of it, and it tells them what they want to collect against.
Yeah,
simple as that.
Much quicker decisions. Yeah,
absolutely. Yeah, and it's the access has always been the problem, and I think that's what we've solved as a business over the last couple of years.
So open finance is coming round, and it sort of went quiet for a while, but now it seems like it's coming back on the radar screen again. I mean, how do you think that's going to link? Is that going to give us new capability, do you think, in terms of, we obviously got open banking that's there, which is much more sort of transactional. I mean, ultimately, open finance is going to go into the insurance market as well, which was, some of the stuff that, links with you guys as well, and some of the clients there. I mean, do you think it's going to have an impact? Can you see opportunities there too?
No, again, I think I'll go back to my 360-degree view, the wheel of the customer at the end of the day, very heavy on. I mean, it's the holy trinity, really, isn't it? It's about exposure, it's about your income, and I think assets is a key part of that as well. One of your biggest assets is the property. I think that is a really important part of how you evaluate the consumer. And I think it has the ability to sort of impact and change product development and proposition development in terms of the organisations that are out there in all markets at the moment, because there's another aspect which they didn't know about that consumer.
I mean, when you look at the data, and the data keeps on building, I mean, how much do you think are we done? I mean, do you think there's going to be more we can get? Is there more property data that we can get that could add even more insight?
Well, there is. I think.
Where do you sit now?
Yeah, one of the big areas for us at the moment is around climate change. So we talk about the value of the assets at the moment. There's something called RPC 2.6, which is it's a modelling standard in terms of 50-year window in terms of what's happening in terms of the UK. So we think about assets at the moment as we move through those periods. I think it's chunked up into 5 years periods over that time. The value of that asset can completely change. Based on the fact that you've got shrink swell in land, it can affect subsidence on properties, etc., etc.
Flooding.
So that's where we're going with that. So it's the PRA have put something out there. It's one of the things that needs to be assessed now in terms of insurers, but also mortgage lenders as well. So that's really key, and I think that has a knock-on effect to anything that's going on in the collections market, because is what you're charging against of any value, and that's the key point. We've done another piece of work recently on obviously the Grenfell piece with cladding. There was a ruling came out. I think if a property is over 18 metres, and we can identify cladding from satellite imagery and that kind of thing. So what the pieces of work that we've done is looked at the portfolios of a couple of financial institutions to assess how many properties fall into that category. And obviously for them, there's a value at risk of those properties as well. So we're moving more in that direction. It's connecting the sort of physical attributes of the property up and look at the impacts through that property chain, really. Is it going to affect its transactional capability, and is it going to affect its value at the end of the day ultimately? And again, all those key points are embedded within the collection services that we use, the insurance services that we use, the full sort of gamut of data.
And how quickly do you think those things are going to change? For example, climate risk change. I mean, is it is it going to be? I mean, we've seen, I suppose, even just through the pandemic, just like how quickly society can change in some ways. In terms of like we're doing things digitally. I mean, the even changes like valuations, because the demand has changed between, say, London and the regions, those kind of things. I mean, do you have any view on how quickly these things could change, or how often it needs to be updated?
Yeah, I mean, these things are updated, regularly. We're getting data in on a daily basis on things like climate change. It's important. It's on our doorstep now, and I think it's that sort of realization that it's sort of there. I mean, one of the lenders that we do this work with as well, they look at it from a very different point of view. So it's not necessarily about there's a risk to the property, although that's very important. It's about how they can help the customer. I mean, there's a very simple thing which surprised me. I went to a conference on this not long ago. If you've got a flood risk on your property, you obviously risk devaluing it. It may not become uninsurable. One of the key things that you can do is build a 30-centimetre doorstep on your front door, because it'll stop 70% of all the water ingress. So then they're looking to do further lending, sort of help them do the remediation to put the value back in their property. So it's the full range of stuff. It's assessing the risk, but it's also helping consumers to sort of mitigate the risk.
Yeah, it's almost like so as much as it is around it's the loan that's made, it's also then how can you then also provide the better customer journey up front to then help them mitigate some of that stuff again, so it doesn't become a problem, right? Because you'd rather not pay out for flood damage altogether. You'd rather have them actually protecting some of it.
Yeah, and I mean the other thing as well, Chris, to consider is that if there is some kind of catastrophic event, that you do have a flood in your house, it's going to impact you financially as well. I mean, we do the whole piece around there's the residential element, but we also look at the vulnerability of commercial premises as well, down to the sort of typology of the business that they do and how it would be impacted by that flood piece as well. So that has a knock-on effect for employment, the infrastructure, whether electricity is being supplied, that whole sort of piece. So it's really important. I think it's one of these big changes which you don't really consider the impact which it has. It's very much like the pandemic. Look how that's changed everybody's lives, how it's impacted business. If we start having major catastrophic events, it impacts everything in every industry, from people's ability to work to their physical assets and their property, and the financial impact that it has on them, and also emotional and social impact over that piece.
you'll be able to measure from your property data about how many buildings have windows that open versus ventilation systems. I'm thinking about the pandemic.
Yeah. It's very interesting, some of the data that you can get out. I mean, there's satellites whizzing over us all of the time. There's LiDAR. They're picking up pretty much everything. I'm really surprised. I mean, just a simple thing. I know European Space Agency, we work with Airbus, all the usual guys. They look at roof lines for subsidence, and if they know the roof line moves over a period of time by more than sort of 10 mils, I think it is, they know there's either something going on in terms of construction inside the house, or there's a problem with subsidence. So they can actually measure that difference in terms of your roof line. It's amazing stuff.
I remember we were chatting in a previous conversation a little bit about shading between buildings, which I thought was quite interesting in terms of like just getting down to that level of detail and almost be able to use it to almost like reconstruct, almost like models in 3D. It's the geospatial stuff, right? It's fascinating.
Yeah, absolutely. Yeah, I mean, it's one of the other things that ourselves and obviously our main investor CLS Risk Solutions sort of do as well. I mean, the mapping stuff's really interesting. I've been involved in analytics and marketing analytics and credit risk for a long time, and we used to use mapping quite a lot in marketing. It's interesting from a strategic point of view, just plotting some of these things on as well. So as you mentioned before, sort of, and areas of risk in terms of flooding, environmental risk versus social deprivation and that kind of thing, and where these sort of overlap. Just looking at areas in the country that that need attention. We were looking at some work for a government agency around where to invest in terms of planning and homes and that kind of thing, and all these things come into account. You layer all that data on, and again we're back to the point where if we have more detail data about how people are operating in those areas, we're back to the bureaus again. It just creates a wealth of data which enables people to make better decisions.
I think it's quite interesting in terms of income shocks as well. So you mentioned around income shocks and being able to predict some of that. So I was before this, I got lost. I was looking up. I know you have data on invasive species. It was Japanese knotweed, I think it was.
It is. Yes,
I was looking up, and you got the data on that. And I got lost into invasive species and maps in the UK on those kind of things. But it is an income shock again. It's just like flooding, isn't it? Absolutely. And all of this. And what's the likelihood of people having income shocks, which then could follow on to the collections process in a particular area or in a particular property as a result of that? And I think that's quite an interesting way of looking at, particularly in terms of portfolio valuations, even collections processes, I'd imagine.
I guess as well, yeah, because I think for me that whole profile of people within that collection cycle, it has the ability to completely change that. I mean, you're going to have people who are going to have pretty much high exposure on properties. You've got a £500,000 property with a £300,000 mortgage on it. All of a sudden, that property is only worth 200,000. It's a big problem. You may be earning a decent salary or whatever, but that is a huge income shock for people, and then it could have a detrimental effect through cascading through the whole financial behaviours.
Do you remember I'm old enough to remember the 80s and 90s when we used to have negative equity. We haven't used that word for a long time.
Right.
I mean, because you could actually use it to identify that, right? So in terms of that, and particularly if we're in a house price correction, do you think we're going to see that again with potentially with COVID, or do you think we're on I suppose it depends what happens economically.
It does, yes. And I think the truth to say, Chris, if I knew what was going to happen, I probably wouldn't be doing this job. I'd be out doing property investment, to be fair. I mean, it's a difficult thing to predict going forward. I think we do it on a shorter cycle. You know what's sort of happening. I think more key to this, as I mentioned, this thing can be thrown on its head all the time. Pricing is a demand piece at the moment. That demand can change from completely different
very quickly
inputs, which we're trying to sort of track, because that's going to be the importance of it. It's about how habitable, how stable is the environment or whatever. We know that the Northwest, for example, is one of the highest areas of climate risk change. It's wet land at the moment, likely to dry out because of temperature increase, which drives all the climate anyway. So there's going to be some issues there. I mean, you've got salt mining up there, you've got the whole range of different things. So those are the things that you need to keep an eye on. If you correct those things now, that you stabilize the whole piece and you maintain the value, you maintain the risk for your own business, but also the individual's risk.
And so how do you get clients to sort of think a little bit ahead around, because we're very good at sort of dealing with risks when they hit us today and we sort of see the impact. Some of the stuff that we're talking about is almost like future risks, and and we want to try and head that risk off now, and that can be difficult. Just as human beings, we seem to have difficulty, and we all know that from dealing with collections, right?
Yeah.
I mean, what are some of your tips in terms of like how do you get people to see some of that? How do you work through some of that, and start to get people planning for it?
Well, I think there's two sides to this. I think the first one is the regulators are doing a good job at the moment, but specifically around certain products. We know it's around insurance, we know it's around sort of mortgage lending. I think what we've been trying to do is it's the awareness of the property information, right? It's getting into the cycles around collections. It's saying, look, what we have at the moment as is the transactional, the attributional piece. I think as that's embedding people to use it, it's that hunger for data. What's going to sort of destabilize that? It's how long are you looking to collect over this individual? How long are you going to have them on the books for? Because we're going to tell you that maybe in 15 years time and something's not done, you've still got them on your books.
Yeah.
That the value of that property's gone, the asset's gone. So your charge is worth nothing.
Yeah.
So it's those type of things. I think it's gradually moving into it. It's a difficult conversation to have around climate change with a collections organisation at the moment, unless you're lending on a property. So mortgage is great, but I think that will come in future. I think it's embedding the importance of the property within these processes and within these sort of disciplines, and then it's exposing the stability of those data assets.
Looking into the future, I suppose, where do we go from here in terms of extra data, other techniques, those kind of things? I mean, what do you see as sort of being the next sort of like 5-10 years? I mean, we're getting ever more data every day. What else is there to do? Where do we go?
Again, the important thing for me is trying to combine these data assets. That's the first step. So I think it'll give you more power and insight if you create that wheel of that 360-degree view. I think the next stage of that, as I've sort of alluded to, is that we're looking at commercial data, commercial businesses, and the risk that's associated with those. I think the key thing is to create that link between the consumer and their income stability. Yeah, it's great seeing open banking and what you're getting in month on month, but if we know that a business is at risk because of an event or something like that, it's translating that across. I think that's a key step. If the data comes around that, which I'm sure it will, I think that's a really key step in terms of bringing those things together. Otherwise, I think it's just around exposing these assets and putting it into an environment where it can be used through the sort of traditional decision in meetings and whatever. It's consideration around data. I think it's getting organisations to consider the wider picture rather than the traditional routes of data that they already have.
Yeah, I love the idea of using the data to then be proactive, to then prevent loss, right? Which is very much rhymes with some of the stuff we've seen in collections around pre-collections, pre-arrears, earlier conversations to help like downstream. And I think that's a really interesting sort of aspect to it, I think.
It sort of naturally gravitates to it. I think it's my mantra really around this piece that you can't do anything without a property. You can't get access to anything. You won't have any services, utilities coming in. You're not going to get a loan if you're not resident somewhere. So for me, I mean, in a lot of circumstances, you look at it from a consumer and a business perspective. It's an important piece that you've got to have somewhere that you've got an address on. So make sure that address is right first, then look at the individual.
Yeah. Well, we all live somewhere.
Exactly. We all have to.
Yeah. Usually the property. Well, Paul, thanks very much for making the time. I really, really appreciate it. And it's a fascinating topic. I mean, the whole topic around data and the amount of data that's available today and being able to predict it is use it for predictive and sort of prevention type reasons is just fascinating. So appreciate your time and thanks very much.
It's a pleasure. Thanks very much.